Cool. All right, we will get started here. Awesome, Perla. Welcome. We've
Hey,
got
Perla.
Monty Springs, Florida. Love that. Irvine, welcome, guys. Okay, awesome. Well, we'll go ahead and get the intro started here. If you're watching this live or you're watching this on a replay, we're really excited to have you today. And my name is Bronson Hill. If we have not met, I'm going to keep an eye on this to make sure we can get Veena up here when she joins. So just a quick intro. This is a Women in Wealth panel. We did this, I believe, last year. We had just a great outpouring of just people loved this. I have a daughter who's turning 13 next month. I want to show her that she can do anything, not just in real estate, but in life. And so how we do that is I think things like this. We spotlight women that are really making an impact in the world. We've got some just really rock star people here. Every single one of them is amazing. And I'm going to get through and give a quick intro to them. So my name is Bronson Hill. I'm the CEO of Bronson Equity. We have 250 million in multifamily assets. We're also doing things now that cash flow like oil and gas and other types of business projects, some VC related stuff. And we're doing some development in Southern California on some fire areas. That's kind of what we're doing. Our panelists today, okay, I've got Veena here. She says she's in the webinar. And I'm going to pull her up. Where are you, Veena? Did you raise your hand? There you are. Perfect. Thank you so much. And promote to panelists. Okay, this should be good. Okay, so you should have an invite there. Okay, so we'll give some intros here to our panelists, our amazing panelists. I have Christina Suter from Christina Suter Wealth Consulting. She's coached hundreds of investors, including myself. When I first started in real estate, she helped me to actually get in motion. Sometimes the hardest thing is not to do the most advanced thing, it's to get yourself in motion. So super helpful. Really excited to have you, Christina. You're also in Pasadena, California. We have Kaaren Hall from UDirect IRA Services. If you have any questions about anything related to retirement accounts, IRAs, all kinds of, she's a wealth of knowledge. She's going to share some of the stuff she's doing. Welcome, Kaaren. You're also Southern California. Welcome. We have Ashley Wilson, Bar Down Investments. I've been invested in a deal with Ashley, just in a wonderful operator, thousands of units, an author, and also the author of the book behind her, the only woman in the room. And so really excited to have Ashley here. She works with Bar Down Investments. Welcome from Pennsylvania. We also have Veena Jetti from Vive Funds. Excited to have you here. Raised over $400 million, have over $1 billion in multifamily assets. So really excited, everyone. We'll go ahead and get started here. Just wanted to kind of go around and let's just talk a little bit about today this is going to be a combination of, what it means to be a woman in real estate or in wealth, and also what it means, like what we're actually seeing right now in the market. So I wanted to start right now, just kind of with the market. Obviously, all of us are investors. We're here. We want to learn how to grow wealth. It's a different environment than we've seen in the past. What are you seeing right now from your perspective? Let's start with Kaaren Hall on this one, and then we'll kind of walk around. You can say what you're seeing economically, what you're seeing in multifamily, what you're seeing in your assets, or just what opportunities. Let's start with Kaaren.
Yeah, I think one of the most surprising things we've seen, I mean, I guess it's surprising in a way, is to see the surge of cryptocurrency and self-directed IRAs. It was kind of just really keeping its little head under the covers there, but now people are really excited about crypto. The number one asset class that we have has always been syndications, and of course, whatever underlying asset that may have. But syndications has been the number one asset class for our whole industry, and now crypto is number two. And so people are investing in that directly through our platform. And so they love that. But then metals are another hot thing right now. Precious metals, gold hit a record high over 4,000. Silver today has the spot prices dipped under 50, but it hit over 50 for only the third time ever. So we were seeing metals at an all-time high. I think has to do with, I know some of you are more economist-like than I am, but you could talk about why the monetary system is the way it is and why people are looking to alternative asset classes like precious metals to invest in. But we have just had a really robust month of people self-directing. So we're seeing a lot of activity.
Love it. Thanks, Kaaren. Excited to have you here. Let's go to Ashley. What are you seeing now? Obviously, kind of where are we, and what are some things you're seeing right now in multifamily and going forward?
In multifamily, I think we're still seeing a little bit of a holding pattern. Rates haven't come down enough to encourage more transaction volume, but at the same time, pricing expectations are still at rates that were mid threes on the 10-year. So I think pricing expectations versus buyers' expectations are totally different. And there's still that gap. I also think we haven't gotten out of the woods from foreclosures. I just reviewed a list beginning of October of all the foreclosures that are happening around the country, and it's still pretty tragic. So I I know that some lenders are trying to work some deals out, but some lenders are being pretty aggressive at taking over some of the properties right now due to either challenges with respect to the debt structure or I should say operating issues that lenders are seeing that we've all seen across the country. So I think it's a bit more of a holding pattern and nothing really significant one way or the other.
Yeah, it's interesting. Sentiment is interesting from investors because a lot of people have had some challenges with multifamily, and yet I think it's a great time right now. It's just, the problem is sometimes things have to change and get much more favorable before people start coming back in a wide level. Veena, what are you seeing right now in multifamily?
Oh gosh, yes, I totally agree with your sentiment that this is a really hard time if you bought assets in like 21, 22 with adjustable rate debt. Ironically, it's also one of the best times to be
Yeah.
getting into the market. And to your point, the challenges, especially when we're dealing with retail investors, is Warren Buffett says be careful when others are greedy and be greedy when others are being careful or scared. And retail investors tend to follow what everybody else does. So everyone's scared right now, so they're being scared. When everyone was greedy, they were being greedy. And so I think we're seeing kind of some of the fallout of the greed from the last several years. And now is the best time, in my opinion, to be getting into the market because we're either at the bottom or near the bottom of a cycle. And, we want to buy low and sell high. And so this is actually a time to try to overcome that fear and start going into the market harder than we've ever gone before because there's so much opportunity from the distress that's happening.
Yeah, I think so. I think we see it too with really sophisticated or family office or larger groups are just buying like crazy because they
Um,
see that. But if somebody's like, I was talking with, I think Michael Blanc a while ago, and he's like, oh, I've been hurt in multifamily or I've had challenges there. So therefore multifamily bad. I shouldn't do it. It's like, well, no, it's actually a really good time to get in. It's counterintuitive. This is where it can be moving past your kind of, I just think there's some really great scenarios that are going to happen for people to get in these days. Christina, let's hear from you. Obviously, I really respect your economic view of kind of what's happening. Can you talk a little broader about real estate, about what opportunities you're seeing now currently, and love to hear from you.
Sure. Thank you for thank you for the queue up. I appreciate it. So I'm more in the 5 to 50s. I'm buying in Tulsa and Indianapolis in that smaller bracket. And I agree there's a disconnect. I could get to economics too. There's a disconnect between what the sell price is and what it is that we want to buy it for. But if we can buy it for what we want, and I'm slowly seeing people, small multifamily mom and pops capitulate and be willing to lower the prices. I just bought one that has fallen out of escrow twice, and finally I'm the one. He's like, okay, fine, the electricity sucks. I admit it. Like, okay, finally, about time. I'm finally seeing movement. And the reason why I mention news on the street is because that's the first place where we're going to actually start seeing whether people are accepting that or not. The amount of multifamily loans that are come due in 2026 is about 89 to 90 billion. So that's actually a good segment of the entire market of mortgage-backed securities or loans against multifamily in the US. So that's actually a good chunk. I don't know if it's exactly a fourth or a third, but I think it's probably closer to a fourth or a little bit less. So we're going to see some opportunities of people being cornered, of owners being cornered and having to refinance in a slightly higher interest rate environment. And I say slightly only because the interest rates are starting to move down. Right? We did see the Fed discount in September. We are anticipating 2 or 3 more discounts, maybe 1 or 2 before the end of the year, another 1 or 2 in the beginning of 2026. And depending upon what happens in May, when Powell will probably be rotated off and we get a new Fed chair rotated on, not a prediction, not a crystal ball, like crystal balls, create trouble, but a possibility that will happen. We might see more discounts in 2026. We got to get below 6% for it to be meaningful. I think both in single family and multifamily, we need to get below a 6% mortgage rate available. Then I think we'll see movement. But until then, we're still going to see a lag in single family and multifamily in people really being able to buy. But that being said, now is the time to buy. The higher interest rate environment, you marry the property, but you date the rate. So you can buy a property now that works at today's rate. That's fantastic. take it, run with it. The hard part is getting investors to understand that and believe in that the refinancing in 2, 3, 5 years will be valuable because the rate will most likely be lower. Percentage chances it will be lower. So I tried to cover 3 topics very quickly.
That was great. No, I love that. We're going to do some Q&A along the way. If you have questions, you can put them in the chat. We will be taking questions toward the end, so feel free to jump in there as well. And that's a really great point. I think, for most investors right now, it's like, well, what do I do right now? We worked on a couple of multifamily deals last year. I've heard some people say it's way harder to raise capital, and we've experienced that as well for specifically multifamily. But how have you changed either from your approach with investors, how you're presenting this to investors, or maybe on your asset management side, or even, for Kaaren, who works with different assets, what are some things maybe right now in 2025 that you're doing different? Let's start with Kaaren on this one, and then we kind of work our way around.
Well, I have a question for the multifamily women here. Is that are you buying rate caps? Because that's one of the things that hurts self-directed investors is having to come up from their idle cash, from the cash that's in their account for these, for the calls, the calls. And so are you buying rate caps?
We did on all of our adjustable rate debt. We are no longer buying with adjustable rate debt right now. So the assets that we've acquired without it obviously don't need it. But that was the one thing that actually saved us a lot during the 22 onward decline, is having those rate caps in place. Because like the Apple's Way portfolio, right? That's like the one everyone talks about, because it was like one of the first big portfolios to come down. And when you look at, and I wasn't involved in that deal, I don't have any insider information. This is all stuff I read online. But when you look at the fundamentals of the deal, where they went in with like a 3% interest rate, I don't think they had a cap, or it expired, and then their rate adjusted from like 3 to 8% overnight. There's not a whole lot of assets that can really sustain that, if any, especially if they're newly acquired assets, because you haven't been able to get in there, build up the NOI, increase the operations, decrease expenses, and you have a new tax and insurance bill when you've taken it over. So now you're just putting so much pressure from multiple different directions. So to answer your question, Kaaren, yeah, we always bought with rate caps, and I'm very grateful that we did that.
Yeah,
We
that's a
only
good thing to
had
tell
one
self-directed investors. I would just throw that out there.
Oh, yeah, okay, great. Thank you.
We only had one property that required a rate cap, or that we even bought on variable interest rate debt. But I would present another perspective to this, just because I memorized the numbers specifically of what our rate cap was costing us. So the first year, the rate cap cost us $303 a month on accrual basis, because not only do you buy the rate cap, but you also have to pay into accrual just like you do for taxes or insurance. So when we initiated the rate cap, we had to pay in 303. A year later, that turned into 1101. A year later, that was 9,200. A few months later, that was 54,000 a month, and a few months later was 74,000 a month. So people don't understand the nuances to
Nice.
rate caps as a whole. And rate caps not only look at the spread, but they also look at the inherent risk of the volatility within the market. So even if you had a rate cap, that didn't excuse you or prevent you from having this run up. I mean, I know of some investments where they all of a sudden were over $1 million a month in accrual because the rate cap, just the spread and the variability within the interest rate environment, specifically the 10-year, there was just so much unpredictability on where the 10-year was going, from a long-term perspective instead of short-term, that's what creates the variability and then the high rates of the accrual. And banks actually didn't know how to deal with this. It's the first time in history that rate caps have gone, or interest rate changes, inflating at such a fast rate. So because of that, a lot of lenders didn't even have provisions in place on how to make these adjustments. Most lenders have a standard cadence of a 6-month review period. So what ends up happening is then you're behind the 8 ball because you've gone 6 months of not accruing enough. So not only do you have a prorated amount for the rest of the year that you have to capture, but you have to capture the deficit you've had for the trailing 6 months. That's the real issue that happened with rate caps. So anyone who had rate caps, I would argue they weren't in the clear because they had a rate cap. I know a lot of deals that were foreclosed on with rate caps. So I would argue that it was a problem. It was a systemic problem due to adjustable rates, and it was exacerbated with properties that lenders didn't require rate caps on, or they expired, to Veena's point earlier. But rate caps it's just a very challenging situation. It's advantageous when rates are decreasing, but the rate at which rates increased was unprecedented. And that's why there were major challenges across the board in commercial real estate.
Yeah, fastest increases in over 40 years, and just really fast, hit a lot of people. I mean, there were deals that we looked at where you start raising money and the rate cap is, 50K, and then you go buy it and it's $1 million. It's crazy like how that changed things really, really fast. So I think that's good. Christina, what else would you like to add as far as what you're seeing now, opportunities and observations on, you kind of had 3 really good points, but do you want to kind of expand on one of those as well?
I was so focused on Ashley's point just now that I thought that was so well said and so well explained, about, how people don't understand the complexities of when you have an accelerating interest rate and what that does. And your not only your interest rate, but your rate cap, but your insurance. And so we have that across different factors. What would you like me to expand on? I was honestly focused on Ashley's point. What's your question?
That's great. Well, I think the question is a little more general from a forward-looking perspective. What
Mhm.
opportunities are you seeing? What are you doing differently now? I know you've become much more active in the last couple of
Yes.
years here in the last year. So talk a little bit about that.
18 months ago, I started buying aggressively in the single family because I was seeing some softening in my particular markets, but I also started lining up for the multifamily, that 5 to 50. I sold my last multifamily in 2011. That was not because I was so brilliant. It was because I needed to sell it. My daughter was born in 2009, and I liquefied my entire portfolio between 2009 and 2011. And that was not the smartest move. I'm just telling you, it was not. If I had known in 2007 what was going to hit us, I would have started selling in 2007 through 2009. But I didn't. And so what I realized was that multifamily being such a solid asset, that it was the first to recover in that downturn. And so the cap rates compressed more aggressively than I've seen. I was able to buy a 7 cap in 2001 in LA, and that just doesn't exist anymore. Thank you, Veena. Somebody who understands why that's significant, right? Like, no way, it doesn't exist anymore, right? So I actually did start buying aggressively because I've seen this before. And so when I say to people like, no, now is the time to purchase. You want to buy the property but date the rate. Now is the time to bring things into your portfolio. So if you have like as a wealth advisor, right, working with people as a registered investment advisor, specifically working with my clients, they're like, oh, I hear bad news about multifamily. I'm like, no, 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 you don't understand. If you find a cash flowing multifamily right now, you have 2 forms of return immediately built into the property. One of them is generally that performance will go up because we have a lack of housing in the United States in general. We're still 3 to 6 million units short, and we don't have a lot of new construction coming online. So we're continuing to lack in having units for residential. And the second is as soon as you refinance for that interest rate actually being more negative, well, less in the future, you're going to immediately be able to have greater value in the property. So if you can find almost anything that is positive cash flow day one after your rehab cost, your sunk cost, you're actually doing really, really well. I have 2 cycles left. I'm 57. I have 2 cycles of investing left to me as a professional investor. I'm doubling down in this cycle because I want to build my personal portfolio as well as my portfolio for my investors now. If I can find stuff now, it's in 2 to 3 years that's actually going to be harder. How I'm changing my investing is I'm not looking to have a 3 to 5 year turnaround on my buildings. I'm telling my investors specifically, we're looking at a 5 to 10 to 20 year timeline. And so I'm cultivating a different relationship with my investors than maybe in the previous cycle. I want long-term investors with long-term horizon lines so I have space on the building to choose when we're going to refinance and to choose if and when we're ever going to sell. But I'm focused on cash flow investors and not necessarily appreciation investors. I'm in a slightly different subsegment of the investor market.
I think that's
So,
good.
yeah.
I appreciate it. That's wonderful. Anybody else want to add anything else as far as current opportunities you're seeing? It could be multifamily, could be something totally different. That's just something you're invested in, you're excited about personally.
One
Well,
thing,
to piggyback off of what Christina just said, sorry, Veena,
no,
just real quickly, to piggyback off of what Christina just said, we see the opportunity in development. So if you can
Mhm.
get a development
Yeah.
deal, use HUD financing, which we currently have a project that, checks those two check boxes. To Christina's point, we have a gap in supply, and basic economics dictates when you have a gap in supply, but you have sustained demand or increasing demand, prices increase. So if you can find the capital structure that works, which HUD allows, makes it a lot easier to make these deals pencil right now,
Mhm.
then you're in a position where you can participate in the wave, which is ultimately what we're all trying to do.
Yeah, love that. Go ahead, Vina.
well, the only thing I was going to add was actually on Ashley's point from before when we were talking about rate caps. I think one of the things that surprised me when we were having our discussions about extending rate caps with retail investors, and by retail investors, I mean non-institutional, not family offices, not ultra high net worth. I'm talking about the everyday high income earner that fits the accredited definition, maybe because, they have a business or they're a doctor or a lawyer or whatever, right? Um, there's a really big fundamental misunderstanding on what a rate cap is. It's an insurance product, right? So every month, regardless of what the mortgage is on adjustable rate debt, you have to still pay the entire debt service, even if it's adjusted to 15% or something crazy. You still have to pay it. And then you go to your rate cap insurance and say, hey, I paid a 15% rate this month. And they'll say, oh, okay, here's the 10% back. So now your rate is effectively 5%. It is not a product which says, okay, you are capped at 5% forever and you're going to just pay 5% and call it a day. And I think what retail investors didn't understand, especially early in like mid 2022, when rate caps and when all rates adjusted to their rate cap pretty much in the course of what, 1 to 3 months, they didn't understand why our T12 was showing cash flow after debt service or before debt service, and then why all of our funds were being swept up because we were distributing monthly at that time. And that was a really big mistake because our investors got used to it. And then you can't really manage cash flow as well. So now you're paying, call it an extra 200 grand a month toward the interest rate, and you're going to get it back, but it takes 4 to 6 weeks to recapture that back. And so you kind of fall into this cycle where you're at any given moment putting hundreds of thousands of dollars, depending on the size of the deal, right? You're putting hundreds of thousands or tens of thousands of dollars that would have otherwise been used for capex or distributions or reserves or whatever. You're putting that out and then waiting for it to come back, and that constantly gets caught in the cycle when you're at your max rate cap. So I think that was something that kind of surprised me, is how much of a misunderstanding there was about what rate caps are. And it does protect the property, but there's still a downside when you have reached your cap.
Right. That's a really great point. I wanted to say something quickly. I'm going to shift here in a minute, but about what Ashley was talking about with development. I think it's interesting as an investor, anybody who's a passive investor, you have the freedom to kind of invest in whatever you want to invest in, right? So you can do real estate, you can do oil and gas, you could do development, you could do coffee farms in South America. I mean, you kind of do whatever you want. And so it's interesting. Sometimes there are niches that show up. And for us, we've shifted a bit to go into some development of single family properties where there were fires in California. So we're bringing in modular homes. These are typically built for 50 to, substantially less in price. I don't know the exact price, but substantially less. And we're becoming licensed to kind of bring those in. And so we're kind of looking at niches like that. So sometimes opportunities will come up either because of a disaster, because of interest rates, because of all kinds of things. So anytime there's something doesn't work, there's opportunities that show up in another way. Someone respond? Yeah, go ahead, Christina.
I wanted to, yeah. So Ashley and Bronson both, because you guys are both now in development, basically land and developing. This is the part of the cycle where development starts to make sense because you're waiting for the bottom of the cycle to happen, and then you're waiting for the recovery. And it generally, after the Fed does its in the last 6 downturns, in the last 6 recessions, when the Fed has stopped increasing their interest rate, if there is a downturn in single family, it takes about 9 months for that bottom of the market to show up. Because there's not always a downturn in single family in every recession, right? So just doing the data. So we still have a bit of a lag here before we're going to see the bottom of quote unquote residential markets. But that being said, development allows you to get past that lag and over on the other side by 2 to 3 years, where the market should be recovering based upon previous cycles. Could be wrong. I was wrong in 2007, 8, and 9, so it could be wrong, right? But that's generally the cycle. The advantage of, I think, of the modular home, which Bronson you're working on, and I support greatly, is that it doesn't rely on local crews. So in LA in particular, local crews and the cost of building in that area has gone up by double, if not triple, anywhere from 650 square foot to 1,000 a square foot. But if you're using crews that are outside of the LA area and now you're bringing it in because it is a prefab or modular, then that price also goes down, as well as the timeline of being to anticipate what it's going to be. Because we're in this bubble here where construction is much higher than we have actual capacity to do. But again, the timeline works, whether it's Bronson or Ashley's projects. That timeline is supported by the market and not discounted by the way the market is going at this moment.
We had a really
Christine,
great.
I was
Go
going to
ahead,
say,
sorry.
Christina, what you just said is so helpful for self-directed investors too. Where should I be looking to place my money? Where are we in the cycle? But I just want to ask, if I can, now, given what we just talked about adjustable rates and rate caps, are you taking on, I think, Veena, you mentioned, are you all taking on, fixed rate debt?
Yeah, we're actually, the last 2 deals that we did, we acquired with a loan assumption, and the one was 2.77%, the other was 2.95% fixed. The one in Arizona, there was 12 years of term left on it, IO and term. So that one, like, I could buy that and I could just sit on it for the whole entire cycle and still do fine there. So yeah, we're really focused now on the debt structure. Also, we've made a little bit of a shift away from the everyday retail investor. What I've learned through this part of the market cycle with retail investors is most retail investors are not thick-skinned enough to handle a major swing in their portfolio.
Yeah.
And it's not a knock on them. I understand it. Like, I'm having trouble stomaching the swing on my portfolio, right? And the reality is everything works in a cycle. What goes down must come up, and what goes up must come down. And so this is the hard part of the cycle. And retail investors are panicking. They're scared. They don't like. Then I was actually, just before this, I was on Joe Fairless's podcast, and we were just talking about sentiment before the show. And I told him, I said, I have investors that I'm capital calling on one of our assets, and I have investors that are asking me if I can liquidate their position because they have a family emergency or whatever. I'm like, no, like, I can give you $1 for your position. If you want that, I'm happy to do that. But no, if there's not an open market for this isn't like a stock or a crypto coin, right? This is a liquid, tangible asset. And so it's just, and they're accredited investors. We do 506Cs, so we have all accredited investors, and having accredited investors that are asking me to cash out on an asset that I'm actively in the middle of a capital call on just tells me that the level of education is still not where it needs to be, even though I know all 5 of us educate and educate and educate, and there's so much content out there, and AI makes it so easy to have all this information at your fingertips, and it's still not well known for retail investors that are smart. They're smart people. These are not idiots that don't know what's happening. They're smart people, and they still don't have a really good understanding about the fundamentals of how these types of deals work. So for us, we've shifted more focus toward larger check writers, family offices, ultra high net worth, institutional partners. Because when you have a $20 million check from a single check writer, and then there comes a moment where you're capital calling $5 million, they're to save or come behind $20 million. They're not trying to understand the nitty gritty of the market. They're going, okay, what is the likelihood that we can achieve this? Is it enough time? Do we have a viable plan? Go. And they're writing a $5 million check. Whereas doing a capital call with retail investors, it is almost more work than doing the initial
Oh
raise.
yeah.
Can
Yeah.
I
Yeah.
add a couple points here,
Yeah, please.
Bronson?
Please.
Just to piggyback off of Veena, I completely agree with everything Veena just said. And the one thing I would add is I think this just speaks to the state of the industry and the education as a whole. I don't doubt at all that Veena and her partners educated all of their investors, but I think as a whole within the entire industry, if you look at the run up of multifamily and who was attracted to multifamily syndication, there were a lot of uneducated folks that were promised a quick payday. Multifamily is not a short-term game. It's a long-term game. People got Pavlov dog syndrome with these quick transitions and they thought, okay, I'll put my money in, I'll have it in less than a year or 2 years, and I'll be able to flip this profit. In fact, people were rewarded for not operating these properties because people paid a lower cap rate for a quote unquote value add deal. And that's a problem. And that's the reason we're in this situation today. People failed to operate these properties and failed to educate their investors and then failed to protect the investors' capital, which is the number one reason we are in business in the first place. People forget that we have to protect not only the capital that's placed, but bring back friends with it when we return it back to the investors, but educate them on the reason why you invest in multifamily in the first place. And it's a long-term game. I think overall the industry was so really jumping at this opportunity of buying all these deals. They bought them on the wrong debt. And then folks got into this situation where they thought they could liquidate their investment. They don't have to participate in capital calls. And that created this sentiment that multifamily is the issue. The issue isn't multifamily. The issue is the lack of education. And I firmly believe whether it's investing or any other, thing that comes across you in life, you have an expectation. And if reality doesn't meet expectations, then you have discordance. That's when people get upset. But when reality meets expectations, so for example, we always do a sensitivity analysis when we present a deal. We show them the change in cap rates and what we would have to hit from an NOI perspective and what yield of a return that gets you, depending on where cap rates adjust. So going in all of these different scenarios, not one scenario with a projected IRR of 15%, but these swings in returns. That you have to show these different scenarios to model out all of these different situations that can come up, because there are just too many variables to have a crystal ball and say, okay, we're going to be in this project for 3 to 5 years. 3 to 5 years, no, you should have debt for 10 years plus on these deals, and people didn't. So there's just so many issues that I think came to a head, and the reason it did is because of the lack of control in this industry. In residential real estate, when we had the Great Recession, all of these different policies came to effect, but all of this turmoil in multifamily, have we seen any changes in policies or government restrictions? No, there's a pursued just ability to be able to operate and to invest in multifamily without these safeguards. And I predict that we will be having this same conversation in decades to come, because there is nothing that has changed to prevent people from falling into this trap in the future.
That's interesting, because on top of that, if I can add, they're looking to like lessen the accredited investor status and make it easier to become accredited, and therefore easier to get into a deal like this without the comprehension.
We're talking, actually, they've been talking about having a test. I think Mauricio and others keep talking about this, like a test that you take, and they've talked about doing it. They just haven't created it. So instead of accredited being how much money you have or how much money you make, it has to do with you understanding a test. I think that would be a great, like almost like a financial advisor kind of test. You have to understand the risks and suitability for you as an investor. I think that could be good. Christina, I know you're talking.
I have a quick question for Kaaren. I think Karen's in a rare position of being able to hear investor sentiment and being able to observe how it physically shifts their holdings in their portfolio. Kaaren, what are you seeing in people's point of views as far as their trust in syndicated deals? I mean, they're going, you said they're going to crypto and they're going to gold. Why don't you tell us a little more? I think, and I like to hear just news on the street. What are you hearing news on the street?
You will understand that when someone puts their money in a retirement account, it's a long-term hold, so it's not like they're trading online or something like that. So when they get in something, they're in something. The new people that are coming to us, what are they investing in? It's still number one, syndications.
Okay.
So we're still seeing that, but I just think that what we've we've really discussed this is that we had a problem in 2022, or it was great to get in 2022, but by 2024, wow, it was a different world and there were a lot of capital calls. And now here we are at the end of 2025, and y'all say that you're getting, and I could say y'all because I lived in Texas, so y'all are getting fixed rate debt, and so it's a different game today, but I still see syndications as number one, again, with crypto rising.
Okay.
Love it.
Thank you.
I wanted to just take a quick pause here for a second. This is awesome. We've got about 15 minutes left. This will go out as a recording. So if you miss it, you want to share it, it's going to be awesome. If you have questions, please do put them in the chat. I wanted to do a plug for something that we are working on coming up, which all of these ladies have either been at or are interested in coming to. So we were in Dallas, Texas last month with Veena. She came and spoke. We had a panel there. We had a bunch of high net worth people in the room, and it was phenomenal. Let me see if I can find this.
Veena was the star. They said, "Hey, what's your takeaway?" Well, Veena said this,
Veena,
and she's so
Veena.
fascinating. Yeah.
Yeah,
Didn't we
it-
hear your
Yeah.
name a million times, right, Christina?
Yes. Yeah. At least
Yeah.
a million
we
times.
did. Yeah, it was really great. So
Yeah.
we're gonna have Kaaren and Christina are actually members of the Wealth Forum. So we found one of the best things we can do is just get amazing people in the room. And so I'm just gonna share my screen for a second, and then I'll share this with you because I think it's worth it. And then we'll come back. If you have questions, this is a great time to pop them into the chat. So this is basically what we're doing. This is the Wealth Forum. It's for high net worth investors. We have a lot of people that are 10 to 40 million. We have some people that are 2 million or a million plus. But basically, the best thing you can do is get in the room with other people that are like you, that are not pitching anything. There's nothing pitched here except for the group itself. And we found some incredible value of being in a room. People are committed to each other to help each other grow. So when someone says, I've worked with this operating group or this partner, this investment group for 10 years, and they're amazing, and don't work with these guys and whatever. So we share those notes and we brainstorm, we find tax strategy, we find all this stuff. So normally we charge, as actually an annual fee that we do for the event, we would normally charge $59.95. We're doing $9.95 for this event. So if you're interested, I'll stick it in the chat. It's a full day mastermind event, includes some meals, includes an adventure. We're going to go to the Huntington Library, which is it's the most closest to being in a European garden I've been to, without actually more than even being in Europe. I've been to 48 countries, and this feels really amazing. So I'll put this in the chat so you can see it, and then we'll take some questions here. But one question that I have for you guys is I don't see questions coming in. Obviously, being a woman, it can feel different than kind of being in an industry where you're not the majority of the people there, and also even having partnerships either with men or with other women. How would you like encourage someone who's a younger woman who's like, I don't know if I can do this, right? There's some doubt, and so like, how did you kind of get going in that? I'd love to just hear maybe from each of you on that.
I don't mind starting on just, I don't think about if I'm a woman or not. I represent $40 trillion in retirement savings that people can tap into for their deals. Either people want to take advantage of that or they don't. It doesn't matter if I'm a woman or not. I don't always think about that. I mean, a lot of times you've got the bros, and they're doing their thing and they're jumping out of an airplane or something like that. Love them. That's awesome. I'm not jumping out of an airplane. That's probably the only difference I see in like where I'm at space wise. But I mean, it's what value do we bring to the table? I don't know about you other ladies, but I typically don't think about it.
Thanks, Kaaren.
So I have a little bit of different perspective because I actively think about it most of the time.
Yeah.
And the reason is because one, I think it's a superpower to be a woman in business because we just make better investors than our male counterparts. This is not me just having this opinion. This is actually a data-driven opinion that I've come to. So that's number one. But number two for me is I'm raising twin daughters, and I don't want them to be walking into a room in 20 years and thinking they don't belong there because they're the only woman there. And I think the only way for or the only way that I know how to do anything about it, is to change it and to bring attention to this issue, because I speak on a lot of stages globally, and there are so many major stages that I've spoken on where I am the only woman on the stage, or there's like two women on the stage, and it's almost like, okay, I'm just trying to check a box here. And it's really an oversight to assume that you just need to check a box when women are in leadership and representation. And the dollars are changing hands, the control is changing hands. And so for me, I want to change how the industry operates. I don't want it to be remarkable. I don't want us to have to do women's panels because we're just represented everywhere equally. And so one of the tips I can give anybody who is a woman trying, especially if you're trying to get started or trying to break into a male dominated industry, with social media being as prevalent as it is, like even with my daughters, I am very strict about what they are allowed to consume, because our brains are malleable, and neuroplasticity, plasticity, we're learning a lot about it now, right? And things that we didn't even know before. And so I want my daughters to consume content from more women, from people who believe in great leadership and integrity and honesty, and that there's more than just IQ, there's also EQ. And so I think if you're on social media, which is where most of us consume and, mindlessly doom scroll, I'm really, really particular about, I block, or not block, but like mute or unfollow men specifically that give advice that is not inclusive of women. And it's not that they're bad or wrong, they're just not speaking to me. And I don't need to hear that, right? Like Cody Sperber, who's a very good friend of mine, his content is not made for me. He talks to young men on how you can be better at male leadership. And so his content is great for someone else. I don't want my daughters consuming that because he's talking about like getting in an ice bath at 4 a.m. No, I don't want to do that. I'm not interested in being in any kind of ice situation. I want the beach as my vacation spot, right? Like, so all that to say, be really careful and mindful about what you're consuming online. And when you're mindful about it, you can catch stuff that is not intended for you or that doesn't align with you. And I'm not saying you have to follow and like the things that I like. It has to be in alignment with your value, your morals, your integrity. So just be mindful of that and don't allow room for things that are negative or out of alignment with you.
Love that. Thank you.
If I may, just because
Yeah.
I'm passionate on this topic as well. I do notice whether I'm the only woman in the room or not. And for years I didn't. And now actually I have, with all the people who've walked up to me, women who've walked up to me and gone, oh, you're a role model for women in this field. And I'm like, oh yeah, I guess I am a woman. Like for a while there, it was just like, oh, I guess that's true. But I come from a different background. So I have a bachelor's in business, but I have a master's in psychology and I have a teacher's credential. So I really come at this from more of a psychology point of view, and I think Ashley does as well, right? We kind of have that, and I'll let her speak for herself. But I'm more aware of the person I'm in front of, and how does that person think, and that's represented in the way they talk, but it's also represented in the gender they seem to be, because not all genders are as obvious today either as well. So I don't want to be too assumptive on that. But men do have a tendency, they do have a tendency to think more in function and form and structure. And it's one of their superpowers is over there in function, form, and structure. And so I want to speak into function, form, and structure when I'm talking to a man, so they can see I'm a team member that aligns with their understanding. And that is the superpower they have given the world for literally decades, if not hundreds of thousands of years, is that. And that's part of why we have this extensive form and structure that we live in, whether it's houses, whether it's highways, whether it's cities. We have that in part because of the way their mind works. But our minds work where we're capable of being more adaptive, more adjusting as both a parent, as a mother, as a teacher, as a community member. We look more through those eyes. So if I'm talking to a person who speaks through that, I want to speak through that channel so they understand. It's like when you're talking to an artist versus when you're talking to a musician versus when you're talking to an engineer versus when you're talking to somebody who loves math. My daughter loves science. So we geek out on the cell structure and what she's doing in chemistry class, just as much as I'll geek out with my good friend of mine who's, an artist, and we geek out about colors and what does that mean and why does she want that particular color. So, but I think as a team member, it's important that I understand the team members I'm interacting with and how I can align those team members as a leader for their position in the project and the power they bring to it. And whether that's a man I'm working with who's going to bring a certain form of power, I want them to understand I will operate with them as an equal and valued team member. And I expect this to be their value as a team member. And I want to empower them and enliven them to that thought. Or it's a female and I want to do the same thing. So I really kind of focused on that. But then again, I have all this background in psychology and as a teacher and being able to interact with people, it's one of the things that I bring. And I think for me, it's a given. Maybe I'm very, very arrogant. Maybe I'm wrong. You guys can throw tomatoes at me later. But I think it's a given that we're going to have a much greater balance between women and men. And that's in the real estate industry. Like, that's just what's happening. I loved at Bronson with the wealth forum, and that gentleman who was from Canada was like, 60% of the room in my investment world is women. So I kind of don't know what you guys are talking about in the US because mostly as a man, I'm a minority and I interact with 60% women in the investment room. And I'm like, oh, good, because the US is going that direction. So in my mind, we're there. Like, it's already happening. It's already integrating. We're already seeing it in the next generation. I'm seeing it in my daughter's friends where they really have a different interaction between them and their female friends and their expectations. My daughter acts very differently than even I did with her expectations around men, women, and roles. I personally think we're like on a very clear trajectory that women are going to be large, loud, and proud, and our job is to continue to integrate evenly in the community, right? To be able to be that stand for a solid, non-gendered negativity, but a positivity of going, yeah, we're in this together, babe. Let's build community.
I love it.
What
I
does it
love it.
take? So
We got
Ashley,
a couple more
you
minutes. I
run
want to make sure
away.
Ashley
You
gets
go
some.
with
We got
that,
a couple more
Ashley, because
minutes.
she's
Let's
going
and
to
then
have
we
a
got to
great
wrap
voice
here.
on this.
So please
Okay,
jump in,
so
Ashley.
real quickly, I think I'm like a hybrid of everything that just was said. When I first started being in situations where it was primarily male, actually started in high school. I went to an all boys school, but I never really realized like the dynamics between or just the the odds between women and men. I just thought that was normal. And I lived with all men my senior year of college. I lived with 14 other guys in a house. And once again, I felt comfort in that. I have always gravitated to more male relationships than female. I've had a hard time historically having a lot of female friendships. So to me, I actually find comfort in situations where it's primarily male. The whole reason that I came up with the idea, the only woman in the room, was because I was at a conference where there were 450 attendees and only 16 of us were women. And that's the only time it's really dawned on me. Subconsciously, I have really bad knees, but I wear heels to every single conference because people interact with each other at eye level and men are taller than me. So I wear heels every single time, not for some insecurity reason dealing with beauty, but more so I can be included in the conversation. And that's something I realized later in life that I was doing because literally I freaking hate wearing heels more than anything. I literally can't walk after a conference because my knees are so bad. So there are things that I do subconsciously and consciously that is become part of like my routine. But at the end of the day, I think there's a lot of value in being a woman. There's a lot of data, to Veena's point, historic data that women make better investors because they're more calculated at assessing risk for investment. Ultimately, I find that some women have this preconceived notion that there can only be one woman at the table. So there are certain women who take on this competitive nature. I'm a very competitive person. I was a Division I athlete. I'm competitive with myself. I'm not competitive with you. I will never be competitive with you. Even if you try to, provoke me, I'm competitive with myself, but I'm collaborative with people who are awesome to be around. So
Thanks.
anytime that I have an opportunity to be around really incredible women, I try to do everything in my power to highlight them, to put them on Instagram, to talk about them, refer them, make introductions, because I really want more kick-ass women to be role models and be in the spotlight for us all to follow. And the last thing I will say real quickly is that if you just look at the basics of what's going on, we've had a historically predominant male real estate industry. Well, that can only go one direction. And more women are coming to the table because if you look at the education and opportunity that's been provided to us over generations, before we weren't encouraged to work, then we were only encouraged to work in admin fields, then we were put into the STEM fields. STEM is the foundation for why you would gravitate towards investing in real estate. So I think the future is really, really strong for women in real estate. And I would not be surprised if women take over real estate and investing long term. Like 10 years from now, I think we would be having a completely different conversation and people would be laughing at the fact that we even need women panels. In fact, if anything, I think we'll see all men panels as the nuance.
Yeah, well, I think we need everybody for sure. Thanks for sharing, everyone. I really appreciate you being here. This has been incredible. I wanted to make sure we give just a minute to have people kind of figure out how they can reach out and connect with you. You can feel free to drop something in the chat there too, but we'll go around. But again, I just wanted to say from my heart, it's really great to have each of you here. I love what you're doing to really reach women, to promote them, to even just shining in the industry that you're in and really bringing a great experience to folks. And I think that we need more women in real estate in the future for sure. Okay, so let's just take 30 seconds. Just go around. How can people connect with you? Let's start with Kaaren.
Okay, it's super easy. You can just jump on this link and set up a call. We'd love to have a consultation with anyone who's interested in self-directed IRAs, what they are, how you use them, what are the rules, that sort of thing. So free consultation, there's the link.
And don't forget, Kaaren, you have an upcoming meeting that
I do. Yeah, I put it in the chat. We're having
in the
a
chat, but I'm
networking
going
meeting.
to encourage you to share
Yeah.
about it because we're cross promoting it as well on our meetup. So
Yeah, well, and like Ashley, I got to write a book this year with Bigger Pockets called The Bigger Pockets Guide to Self-Directed IRA Investing. And people who open an account with us this month, October 2025, will get a copy of this as a gift. So just saying. So there's that as well. And there's a link in the chat.
Thanks, Kaaren. Okay, let's go keep going around. Let's go, Veena.
So you can reach me on Instagram. It's where I'm the most active. It's actually the only place I'm really actually active. So it's just my first and last name, Veena Jetti. I've also been recently getting into the world of wholesaling multifamily assets, and it's something new that I never really thought about doing at scale until now. And this point in the market cycle is making it really fruitful to do that. So I put together a 28-day step-by-step guide if you want to get into that. You can go to learnwithveena.com, or wait, is it learn from Veena? I don't know. Let me look it up. It's either learn from Veena or learn with Veena. Learn from Veena. Sorry, learnfromveena.com. I lied about this other one.
In the chat. There we go. Perfect.
Yeah, learnfromveena.com. And you can go and download the book there, and you can go through the 28-day guide, and we'll be updating it as we're getting into new money-making fields, and we'll do more education around it, but would love to have anybody there or reach out to me on Instagram.
Awesome. Thanks so much. Appreciate you, Veena. Ashley.
I'm going to use this moment to say that if you enjoyed any of these badass women, you can review them on Conference Connect, and they each have their own individual pages. You can also connect to their social medias off their pages, see where they're speaking next. But I'd highly recommend taking a moment and reviewing them. And if you do it within this month, you have a chance to win $100.
Oh, nice.
So I'll put the link in the chat so everyone can go right away. But it would be awesome if you could provide support by finding them there and then linking to their websites and Instagram and all the fun things.
And is it your handle on Instagram, Badash?
Yes.
I
Which you can
it.
find off of my page on Conference Connect too. So it's a one-stop shop for finding all the links to what everyone's doing.
I love it. Thank you so much. Christina.
Nice, Ashley. I love it. Thank you for including us in that. Appreciate it. I love community. So I'm pretty easy. info@christinasuter.com. My assistant will pick up the emails there. But honestly, you want to actually have a conversation, call me, text me. Don't email me. Call me, text me. So it's
Sure.
310-463-5942. As an old mentor of mine used to say, let's talk eyeball to eyeball and belly to belly. And he had a pretty good sized belly, so I think it was actually belly to belly in some of his conversations. But I think it's still a really good point of view, which is this is a human field. This is about serving each other and serving humans and making the world a better place through the vehicle of real estate while you fulfill your purpose. Let's have a conversation person to person. So 310-463-5942.
Awesome. I appreciate it. Thank you everyone for being here. One comment I thought was great was, let's see, how did Bronson get so lucky to be the host of 4 badass, beautiful women? What a lucky guy. I feel absolutely the same way. So I'm really grateful for each of you. Thank you for being here. Thank you to our audience. We will send this replay out. We will do our next event, which I believe is about creative real estate financing next month. So keep your eyes open for that. Thank you, everyone. We look forward to seeing you guys again soon. And thank you to the ladies on the panel. This was absolutely amazing.
Thank you, Bronson, and thank you, ladies.
Thank
Thanks
So
so
you.
fun.
much.
So
Okay.
fun.
Appreciate you. Thanks.